In this chapter, the author tells a story about a party attended by Kurt Vonnegut and Joseph Heller. Vonnegut informs Heller that their host, a hedge fund manager, made more money in a single day than Heller earned from his popular novel Catchment is 22 over its entire history. However, Heller responds by saying that he has something the hedge fund manager will never have: enough. This simple word enough resonates with the author and prompts him to explore the concept further. The author provides two examples to illustrate the dangers of not having enough. The first example is Rajat Gupta, who rose from poverty in Kolkata to become the CEO of McKinsey and a wealthy philanthropist. Despite his success, Gupta desired to be a billionaire and engaged in insider trading, which ultimately led to his downfall and imprisonment. The second example is Bernie Madoff, who was initially a legitimate and successful businessman before his Ponzi scheme was exposed. Like Gupta, Madoff had already achieved immense wealth and success, but he still risked everything in pursuit of more. The author emphasizes that these extreme examples are not limited to criminals. Even non-criminal individuals, such as the traders at long-term capital management, can fall into the trap of constantly striving for more and taking unnecessary risks. The author highlights the importance of setting realistic goals and not allowing expectations to constantly increase. He warns against the dangers of social comparison, as there will always be someone wealthier or more successful to compare oneself to. The author argues that having enough is not a sign of conservatism or settling, but rather a recognition that an insatiable appetite for more can lead to regret and negative consequences. The chapter concludes by emphasizing the need to identify what is truly valuable and not with risking, such as reputation, freedom, relationships, and happiness. The author suggests that the most powerful tool for building enough is simple and does not require taking unnecessary risks. This tool will be explored in the next chapter. In this chapter, the author explores the concept of compounding by drawing parallels between the cycles of ice ages and the accumulation of wealth. The chapter begins by discussing the discovery of multiple ice ages in the 19th century and the theories that attempted to explain their occurrence. It is then revealed that a Serbian scientist named Milutin Milankovic discovered the true cause of ice ages, the gravitational pull of the sun and moon affecting the Earth's motion and tilt. This discovery led to the understanding that moderately cool summers, not cold winters, were responsible for the growth of ice sheets. The author then shifts the focus to the concept of compounding in the context of wealth accumulation. Using Warren Buffett as an example, it is explained that his immense fortune is not solely due to his investing acumen, but rather the result of consistently being a good investor for a long time. The author presents a thought experiment to illustrate this point, showing that if Buffett. The chapter also highlights the importance of time in the process of compounding. While Buffett may not have the highest average annual returns compared to other investors, his long-term consistency has allowed him to amass a greater fortune. The author introduces Jim Simons, an investor with higher annual returns than Buffett, but a significantly lower net worth due to starting later in life. The chapter concludes by emphasizing the counterintuitive nature of compounding and how it is often overlooked or underestimated. The exponential growth potential of compounding is compared to the rapid advancements in technology, where storage capacity has increased millions of times within a few decades. The author warns against ignoring the power of compounding and the potential pitfalls of seeking high returns without considering long-term consistency. Overall, the chapter serves as a reminder of the incredible results that can be achieved through compounding and the importance of time in the process. It challenges conventional thinking and encourages readers to consider the long-term implications of their investment decisions. In this chapter, the author presents a contrast between two investors, Jesse Livermore and Abraham Gurmansky, whose paths crossed during the stock market crash of 1929. Livermore, a successful trader, was able to profit from the crash and become even wealthier, while Gurmansky, a real estate developer, lost everything and ultimately took his own life. The author emphasizes the importance of not only getting wealthy, but also staying wealthy, which requires a combination of frugality and paranoia. The chapter explores the concept of survival in the world of finance, highlighting the need to avoid ruin and embrace a long-term mindset. The author also discusses the importance of planning for the unexpected and maintaining a barbell personality that is both optimistic about the future and paranoid about potential obstacles. Overall, the chapter emphasizes the importance of not only achieving financial success, but also preserving it over time.